Did you know 80% of day traders who trade options lose money? That's a staggering number, and it's often because people jump in without understanding the fundamentals. Options trading can be incredibly powerful, but it's also incredibly risky if you're unprepared. In this video, we're going to demystify options trading for complete beginners. We'll cover what options are, the core terminology, the two main strategies, buying calls and puts, and how they differ from simply buying stock. By the end of this video, you'll understand the basic mechanics of options and be able to confidently start learning more about this complex, yet potentially rewarding, investment vehicle. Let's start with the very basics. What is an option? Think of it like a reservation. You're paying a small fee for the right, but not the obligation, to buy or sell something at a specific price by a specific date. That something is usually 100 shares of a stock. This right comes in two flavors, calls and puts. A call option gives you the right to buy 100 shares of a stock at a predetermined price, called the strike price, before a specific date, the expiration date. If you think a stock's price is going to increase, you'd buy a call option. Conversely, a put option gives you the right to sell 100 shares of a stock at the strike price before the expiration date. You'd buy a put option if you believe a stock's price is going to decrease. Let's illustrate with an example. Imagine Tesla is currently trading at $200 per share. You believe Tesla will rise to $250 within the next month. Instead of buying 100 shares of Tesla for $20,000, you could buy one call option contract with a strike price of $210 expiring in 1 month for, let's say, $5 per share, a total cost of $500. Remember, each contract covers 100 shares. This $500 is called the premium. If Tesla rises to $250, your call option is now in the money. You can exercise your option to buy 100 shares at $210 and immediately sell them at $250, making a $4,000 profit before subtracting the initial $500 premium, for a net profit of $3,500. That's a 700% return on your initial investment, compared to a 25% return if you'd simply bought the stock. But here's where it gets interesting. What happens if Tesla doesn't rise? If Tesla stays below $210, your call option expires worthless. You lose the $500 premium you paid. This is the biggest risk of buying options: limited potential loss, the premium paid, but potentially unlimited profit. Now, let's look at put options. Suppose you think Apple's stock, currently at $170, is overvalued and will fall to $150 in the next month. You could buy one put option contract with a strike price of $160 expiring in 1 month for a premium of $3 per share, or $300 total. If Apple falls to $150, your put option is in the money. You can buy 100 shares of Apple at $150 and immediately sell them using your option at $160, making a $1,000 profit before subtracting the $300 premium, for a net profit of $700. However, if Apple stays above $160, your put option expires worthless, and you lose the $300 premium. The key takeaway here is that options are leveraged instruments. A small premium can control a large number of shares, amplifying both potential gains and potential losses. This leverage is what makes options so attractive, but also so dangerous. Now, let's talk about the factors that influence option prices. The premium isn't just pulled out of thin air. It's determined by several factors, including the stock price, the strike price, the time until expiration, the stock's volatility, and interest rates. The most significant factor is often volatility. Higher volatility means a greater chance of a large price swing, increasing the value of both call and put options. Think of it like insurance. The more likely something bad is to happen, higher volatility, the more you'll pay for insurance, a higher premium. Options pricing can get incredibly complex, involving models like the Black-Scholes model, but for beginners, understanding these core factors is a good starting point. But here's where it gets even more interesting: options aren't just for speculation. Options can also be used for hedging, which is protecting your existing investments. For example, if you own 100 shares of a stock, you can buy a put option to protect against a potential price decline. This is like buying insurance for your stock portfolio. If the stock price falls, the put option will increase in value, offsetting some of your losses. This strategy isn't about making a profit, it's about limiting your downside risk. So, what's the biggest misconception about options trading? Many beginners believe options are a get-rich-quick scheme. They see the potential for high returns and assume it's easy money. This is simply not true. Options trading requires a deep understanding of the underlying asset, market dynamics, and risk management. The 80% failure rate we mentioned at the beginning is a testament to this. The most powerful insight to take away from this is that options are tools. Like any tool, they can be used effectively or ineffectively. They aren't inherently good or bad. Successful options traders aren't necessarily trying to predict the future, they're managing risk and capitalizing on specific market conditions. They understand the probabilities and are prepared to accept losses as part of the process. Ultimately, options trading is a sophisticated strategy best suited for experienced investors. Don't jump in with real money until you've thoroughly educated yourself and practiced with a paper trading account. There are countless resources available online, including tutorials, courses, and simulators. Continue learning, stay disciplined, and remember that risk management is paramount. Now, if you found this explanation helpful, we have another video that dives deeper into advanced options strategies like covered calls and straddles. You can find it right here. Remember, knowledge is your greatest asset in the world of finance. Don't gamble with your future, invest in your understanding.